All right, let's give it one more minute. I always like to start at 10:05 for the stragglers. If everybody could just maybe comment um, if they're a real estate broker or other. I see a bunch of majority brokers, but just always curious. I'd love to know the audience.
Yeah, because I would say this presentation is actually kind of fitting not only for brokers and so forth, but also lawyers, accountants, and so forth.
All right. I think we probably have like 95% brokers. Don't be shy, everybody. I see a lot more people in here. All right. Good to see familiar faces. Well, I'm excited for this. We have between Chris and I, we've kind of honed in on, think what's needed. And just to kind of, if you take nothing except for this, I think you'll come out in an advantageous position. For you, it's all about issue spotting, right? When you're working with an international buyer or seller, you have to ask the question, right? What their legal status is. And sometimes it gets a little technical, where you may need to come to us to figure out if they're foreigners or not, depending on visa status and things of that nature. But why is it important? Why should you issue spot? Number one, I think you can add tremendous value and impress clients. And if you're competing for a client, there's a few little things you can do to hopefully land that client and land the deal. Number one, if you're a seller, right, there's a concept called FIRPTA. It's a withholding. Um, and it's very technical. And it's so technical these days, a lot of our friendly competitors hand it off to specialists. And the great part about Chris is he's our specialist and he's in-house. So you know how it is, if we do the real estate and we have to refer another law firm that's not really a real estate firm, doesn't really understand real estate cadence, things can just take long and the interest and penalties can be dramatic. More attractive, I think, on the buy side, you're working with the client, and you're prospecting, you're looking at properties, you're, starting your relationship, and you find out they're a foreigner, and you say, listen, I was, present for a presentation, and I learned that as an international buyer, if you purchase in your individual name, as opposed to an LLC or a trust, and Chris will get into it, you could be subject to estate tax, death tax, which could be a huge percentage in the United States, up to 40%. Um, and FIRPTA, the withholding. Now, this can perhaps all be avoided by purchasing in a structure as opposed to purchasing individually. And it's not one size fits all, depends on assets, depends on country, depends on age, which Chris will get into. But again, not to oversimplify, but you're working with an international purchaser, you want to have that conversation, say, hey, would you like me to introduce you to an attorney that specializes in this area? And the idea is you want to get this conversation going early in the process. When you refer me, it's a 15-minute phone call and I get a deal sheet and we're off to the races. This is more of a consultation, right? You're putting together structures. We may need to speak to their international team. There may be more questions. There may be estate planning implications. So I would even recommend getting this conversation going, while you're looking at properties, because sometimes we want to set up these structures before we sign a contract. So we all know once you have an accepted offer, it's go time. We get, a lot of pressure. So the more time to kind of brainstorm, the better. Um, so obviously I run our real estate department. Chris, co-heads our estate planning department. We do domestic and international work, but Chris is going to touch on obviously the international piece today. He'll go over some technical pieces just to give you kind of the big picture. We'll email you this video and this presentation as well. And then at the end, we'll just go over some practical implications. But Chris, I'll hand it off to you.
All right. Thanks, Andrew. It's a pleasure to see everyone this morning. Thank you for joining us. As Andrew mentioned, I'm the head of the Trust and Estates Department here. I actually co-head it with my with my other partner, Talita, who's unfortunately not here today. But so yeah, basically, what Andrew says is I do trust in estates planning, but I also obviously I know the basics of estate and gift taxes, like any trust and estates attorney should know on the domestic side of things. But I also have a niche practice area in the international realm as well, dealing a lot with foreign buyers who need to have some sort of structure for their real estate investment. And as Andrew mentioned, why is it important for them to consider this? It's because, as he said, it's rarely a good idea for a foreign buyer to buy directly in their own individual name. The reason being is that there could be a potential for an estate tax, which is a death tax, right? That could be potentially charged depending on the value of the real estate on both the federal level, up to 40% of the entire fair market value of the real estate at the date of death, and also on the New York State level, depending on the value. New York State has its own estate or quote unquote death tax, right? And why is it, by the way, that this is an issue for foreigners? And why isn't it an issue for me, you, or anyone that's either a citizen or non-citizen domiciled here? Well, if you're a U.S. citizen or you're a non-citizen considered domiciled in the United States, we currently enjoy very, very historically high exemptions. Currently, each person has a $14 million exemption per person on the federal level, which means that you don't pay estate tax. Your estate doesn't pay estate tax until you reach the first dollar or 14 million, and then it's 40% after that. Um, Foreigners are radically different, their exemption. Their exemption is only $60,000. That's if you're a non-citizen, not considered domiciled in the United States. And so if they were to pass away and the real estate's considered part of their taxable U.S. estate, which, by the way, real estate is considered no matter if it's a non-resident. Co-op shares, for instance, are considered part of a U.S. estate. Then it would be a 40% estate tax. Unfortunately, sometimes I get involved only when it's too late, when people have already passed away. Just a sort of an example that of an estate that I'm currently dealing with. A Spanish couple passed away, left a co-op apartment here in the city, probably worth about, I don't know, like maybe $600,000, and because they both passed away, owning the shares, now their estates are looking at a estate tax of around $200,000 total on a $600,000 co-op apartment. Unfortunately, with the proper planning, we could have potentially avoided it, but unfortunately not. So, or mitigated it. But anyhow, so that's just something to keep in mind when you're dealing with foreigners, with foreign buyers. Now, we do regular presentations on estate tax planning and so forth, and there are ways to mitigate it or completely eliminate the risk of the U.S. estate tax. Like Andrew said, it all depends on the client. It depends on their objectives, and so forth. So yeah, it's really a conversation. Another thing that you want to begin this conversation early, like Andrew mentioned, is because in the event with real estate, things get very, very tricky in the sense that if you try to do the planning post closing, then it gets very complicated precisely because of the rules of FIRPTA, which we're going to deal with today. Now, we give regular presentations on U.S. estate tax issues and foreign buyers and sellers that delves more deeply into the planning for estate and gift tax purposes. I'm not going to get into the details of that today, just because I want to focus more on FIRPTA. This is actually the first time I'm doing this presentation on FIRPTA. Usually I combine the FIRPTA issues with the presentation on U.S. estate tax, but I always felt that whenever we do that presentation all at the same time, I'm very, very limited for time. I'm usually only spending 5 minutes on FIRPTA, and I just don't feel that's enough. And I also feel like we get so many questions on FIRPTA from all sorts of different parties, right? I mean, it routinely comes up every other day. I'm getting some form of question about, does FIRPTA apply? What's the withholding rate? What happens if there's two buyers and one's a foreigner and one's not? How does the rules work? So we figured this would be a great opportunity to do an entirely new webinar simply focusing on FIRPTA, because it's also, there's a lot at risk here. There's potential for tax penalties for a buyer to be saddled with an income tax bill that's owed by a foreigner and so forth. So it's really good that everyone knows these rules. Again, like Andrew mentioned, some of this stuff is going to get very technical. It's just tax stuff. Apologies in advance for that. And we don't expect you guys to learn all of this. It's just issue spot, right? At the very end, I do have a little bit of a cheat sheet just to kind of give a couple of tips just to be with certain parties that are definitely not subject to FIRPTA and certain parties that are definitely not subject to FIRPTA. And we'll get to that soon. This is my contact information, also Toledo's contact information. Sorry, Andrew, I forgot to post you up here. But feel free to email me. Feel free to email Andrew. Feel free to email Toledo. Best to reach out directly to me on any FIRPTA questions and copy Andrew. And if you have any questions after this presentation. So let's just get right into it. So if you're a real estate professional, you may have already come across FIRPTA, right? But I'm just going to assume no knowledge here. I don't want to assume anything. So let's just start with some of the basics here. So what is FIRPTA, right? FIRPTA is not a particularly new law. It's been around for about 45 years now. And it stands for Foreign Investment in Real Property Tax Act, right? It was created, I think, back in 1979 and 1980. And the reason why Congress created this law was because before 1980, when a foreigner would sell U.S. real estate, they wouldn't pay any income tax or U.S. income tax on any of the capital gains that they recognized, right? A lot of people thought that was unfair, and it gave foreigners an unfair advantage compared to U.S. taxpayers who did have to pay income tax on the same amount. And so they decided to come up with this law, FIRPTA, which basically governs the transfer of any U.S. real estate interest, either directly or indirectly, right? So it's not, if they purchase it directly, obviously there's a real estate property interest there. But even if they purchase it indirectly, like a company, through a trust, through an LLC, through a partnership or something, if that entity's most of their assets are U.S. real estate holdings, then a potential transfer, either directly or indirectly, of that interest would be subject to FIRPTA, right? This basically applies to any non-US person that is transferring, right? And by the way, the key here is the word transfer. It's not just sale, right? It can encompass a whole bunch of different things. As a lawyer, I have to deal, for instance, with like dissolution or liquidation of like entities, transfer back to the foreign shareholder or a foreign corporation and so forth, right? I'm not going to get into that. That's just going to overwhelm you guys. We're just going to keep it simple because this the most common thing is the withholding for individual non-US transferors at 15% of the sale price. And the 15% actually generally applies mostly to individual US transferors. It can also apply to foreign corporations and so forth. I'll get into that. But let's just say, for instance, let's say you have a foreign seller and they're looking to sell their apartment for $1 million, right? What's the FIRPTA withholding? Easy, $150,000. At the closing table, a check. It's a expense item on the closing statement. FIRPTA withholding of $150,000 of the gross proceeds has to be sent to the IRS, right? A check is cut to the IRS, sent to the IRS at the closing table. That has to be done within 20 days of closing. And by the way, this is regardless of the tax actually owed by the foreign seller. So they, if the foreign seller purchased the apartment for $1 million and then, or purchased it for $2 million and then selling it for $1 million, so they actually made a loss, it doesn't matter, right? Even in that same example, the withholding still needs to be sent to the IRS at 15% of the gross price. Now, it's important to note that the money that's being withheld isn't necessarily the tax that's owed, right? FIRPTA really acts as what we call a withholding mechanism. It's just to ensure that a foreign seller that sells real estate, because now they're getting rid of their US, a valuable US based asset. They want to make sure that foreigner actually files an income tax return later on, which they're meant to do anyway, declares the sale, and then pays any income tax owed on any net capital gains that they were to realize on that sale. And by the way, foreigners generally, at least individual foreigners, tend to pay income tax rates at the same rates as U.S. individuals. But it's essentially that 15%. The U.S. government's holding that money hostage, right? So they take that 15%, and then later on after the closing, they say, "All right, come get the money. The only way you're going to get that is by filing a U.S. Income tax return," right? So, you know, as much as is said about the Internal Revenue Code, about how complex can be, for FIRPTA, there's really only two classifications of transferors. There's U.S. persons and there's non-U.S. persons, right? It sounds pretty simple, I guess, but there's a little bit more involved in that, and which we're going to get into just now. But essentially, U.S. persons who are selling for transferors are not subject to FIRPTA, and non-U.S. persons are subject to FIRPTA withholding. All right. So what's a U.S. person, right? U.S. person, this is for a definition for income tax purposes. Don't forget, FIRPTA really involves income tax, right? So because we're talking about capital gains and so forth on the sale of U.S. real estate. So a U.S. person for FIRPTA, the number one is U.S. citizen. If you have a person that's a U.S. citizen, they will never be subject to FIRPTA. It doesn't matter where they live in the world. If they haven't even lived in the United States ever in their life, but they were born as a U.S. citizen, for instance, or they moved away, it doesn't matter, right? It doesn't matter that because at the end of the day, a U.S. citizen is always subject to U.S. income tax rules, and so they're never going to be subject to FIRPTA withholding. The second, which is very similar to U.S. citizens, is green card holders. If the person has a green card, even if they're not living in the United States, right? Sometimes we see green card holders who have a green card and they probably shouldn't be, but they've lived for many, many years outside of the United States. They are also not subject to FIRPTA ever, because the reason being is because green card holders are have to file a U.S. income tax return every year while they have the green card, regardless of their presence here in the United States, right? They're always considered U.S. taxpayers. The third one, which is super easy, is U.S. corporations. What I mean by U.S. corporations is a corporation that was established in the United States, that was incorporated in the United States. So typically, as a lawyer, what we'll do is we'll look to the incorporation documents, right? So if it was formed in New York, for instance, incorporated in New York, there'll be a certificate of incorporation issued by the state of New York, Delaware, Florida, and so forth. If that's the case, then the analysis has been concluded. No FIRPTA withholding, right? Because a U.S. corporation, regardless of if all the shareholders or all the directors are foreign persons, a U.S. corporation is never going to be subject to FIRPTA. All right. The next one is U.S. partnerships. This gets a little bit more tricky, but they're generally speaking, we're talking about limited partnerships, limited liability partnerships, LLCs, which has more than one member, even if all the members are foreign, by the way. Generally speaking, those are considered a U.S. partnership is taxed as a domestic partnership and not subject to FIRPTA. And then finally is any alien individual. And what I mean by alien individual is not a U.S. citizen and not a green card holder. It's basically everyone else. We're talking foreigners, tourists on B1, B2 visas, H1B holders, any sort of non-immigrant visa, basically. How even if you're undocumented, right? Any alien who passes the substantial presence test. I'm not going to get into this. It's just it's the rule is complex here, but basically speaking, if you spend more than 183 days of physical presence in the United States in one calendar year, regardless of your immigration status, you are considered a U.S. taxpayer for that year, and you are not subject to FIRPTA by virtue of being a U.S. taxpayer, right? So the rule for that, for the substantial presence test, is a little bit complex. You have to take all the days of that current calendar year. You got to then add on a third of the days of physical presence from the previous calendar year. Then you've got to add another six of the days from 2 calendar years prior to that. You add all those up. If it's 183 days or more, then that person is considered a U.S. person for that calendar year, and they are not subject to the FIRPTA withholding. So these are U.S. persons not subject to the FIRPTA withholding, right? All right. Um, so a couple of points to make here, because these kind of issues come up or questions come up with a lot of foreign buyers. Um, if any of the conditions apply, including the substantial presence test, that person is considered a U.S. tax resident, not subject to FIRPTA, right? Which means they are obligated to file the U.S. income tax return in that specific year as a resident. Generally speaking, it does not matter if such person is also considered a tax resident in another country, right? Uncle Sam really only cares about Uncle Sam's laws and whether they consider you a tax resident. Sometimes I have clients, they spend a lot of time here, a lot of physical presence here, even though they're probably on a B1, B2 tourist visa. And then I break the news to them that they're a U.S. taxpayer, have to follow income tax returns on their worldwide income. They're like, oh, well, but I already declare in my home country. It doesn't matter. So now you're considered a tax resident of both countries, right? Um, and so basically, what I mean by that is any non-citizen and non-green card holder that spends what I call an excessive amount of time here in the United States, I would say generally more than 120 days of every calendar year is likely considered a U.S. tax resident and therefore not subject to the FIRPTA withholding, right? So that includes, for instance, an H-1B like a worker visa holder who lives and works in the United States on a temporary non-immigrant visa. If they're spending virtually all their time or most of their time every year in the United States, then they're going to be considered a U.S. person for that tax year, so they're not going to be subject to FIRPTA. But we have to be careful with that. We can't assume anything. There's something called a dual status filing for the first year where they could be considered a non-resident and a resident the same year. They might be leaving that year, right? They might be selling the property because now they're going to go back to their home country. So that all depends on a timing thing as well. So we can't really assume anything, right? So the bottom line is anyone that's on a non-immigrant visa here, regardless of whether it's for work or if it's for pleasure, we should always do a careful analysis there. And one point I'd like to make here is a lot of people tend to assume that if someone has a social security number, that they're exempt from FIRPTA. That is not true. Okay. If they have a social security number and they have a green card or a U.S. citizen, yes, definitely exempt from FIRPTA. But there are people, but social security numbers, when they are issued, they're issued for life, right? So you could have individuals who, for instance, lived here years, decades ago, right? I see this very common, lived here decades ago and were issued a social security number because they lived here and they worked here. And then they gave up their green card or their work visa expired and they went home, but they still maintain property here or still come back to visit. They still have that social security number, right? But they are not a U.S. person, and so they would be subject to the FIRPTA rules, even having a social security number. So just bear that in mind. Just simply having a social security number does not mean someone's exempt from FIRPTA. All right. Now, what's a non-U.S. person, a non-resident alien definition? So these are the people that are subject to the FIRPTA withholding of that 15%. And it's basically anyone who's not a U.S. person who I just did not describe right now. That's any non-U.S. citizen, non-green card holding individual who does not pass the substantial presence test. And bear in mind, by the way, if a foreign individual is not working here in the United States and is not living here full time, and they also have a property here, which usually means they're wealthy. They do not want to be considered U.S. taxpayers, right? That is very complicated and that can give them a huge headache. If they are considered U.S. taxpayers, then what ends up happening there is they're subject to U.S. income tax on their worldwide income. That could be really, really bad for them, right? So I just mentioned that because sometimes I do get clients that they really want to avoid the FIRPTA withholding, and so they say, "Oh, what happens if I just come to the U.S. and just spend an excessive amount of time there for this year, and then I'll be considered a U.S. person, not subject to FIRPTA. I was like, well, that's great. You just skipped out on the 15% FIRPTA withholding, but now you're probably going to have a huge U.S. income tax bill on your worldwide income, right? So it's never a good plan to me. Um, Foreign trusts. Foreign trusts. So foreign trust is super complex. If there's a trust that's the owner of property, it's best just to speak to someone like me, or another professional. Trusts gets wildly complicated, but there is a concept of a foreign trust that's subject to FIRPTA. It can be very deceiving on what's a foreign trust and what's a domestic trust. Um, Sometimes trusts established, like for instance in the Cook Islands or Bahamas, could actually be considered U.S. taxpayers, and trusts established in like New York or Florida or Wyoming and Nevada could actually be considered foreign trusts, right? It gets really, really complicated. Those trusts really have to analyze it. So, foreign trusts though are subject to FIRPTA withholding. Um, the third one is foreign corporations. Foreign corporations, that's a pretty easy analysis, right? Where was the corporation incorporated? If it was incorporated outside of the United States, like it's a British Virgin Islands company, a Singapore company, a Chinese company, a Hong Kong company, a UK company, a Canadian company, if that's where the company was incorporated and established, it is a foreign corporation. It's a non-US person and it is subject to FIRPTA. Okay. And by the way, that's independent of whether their shareholders are foreign or US persons. You could actually have a Canadian corporation, for instance, and all the shareholders are US citizens, right? But that Canadian corporation would still be subject to FIRPTA because it's a separate tax-paying entity, right? So this is what we mean when the rules start getting a little bit tricky. And then last but not least, foreign partnerships. Foreign partnerships, just, limited partnerships and so forth, that are created outside the United States, similar to the way a foreign corporation is registered.
Anybody
All
have
right.
questions? I know it's a bunch of information. We'll also, in a little bit, jump over to, purchasing different structures to give you an idea. John, will FIRPT apply to foreign investors who already own property in New York State but transfer to a single member LLC?
Um, yes, FIRPTA will still apply. I'll get to that. I'm going to get to that. Because that's actually a key point. It's a great question, John, because this comes up frequently and it's very confusing. It's very confusing, the treatment of LLCs with all sorts of professionals, and a lot of people get this wrong. So I'll get to that. I just don't want to get things all mixed up here. But great question. One thing that I want to mention here is that I want to bring up, this comes up a lot as well, is what about FIRPTA withholding with co-owners, right? We've seen this before, right, Andrew, where we have co-owners. We have two or three individuals and that own the property, and one or two of the individuals are foreign persons, and another individual is a U.S. citizen. What happens then, right? Well, here's the general rule, without getting terribly complicated. If the co-owners are spouses, right? And there's a US person that's a spouse, right? It's typically like a US citizen, but they're living abroad. And then they have a non-US spouse who's not considered a US taxpayer, right? Maybe they're just living abroad, but they have a home here. Then withholding is only meant to be made on 50% of the sale. So there still needs to be a FIRPTA withholding, but only on 50% of the sale, right? What the IRS presumes here is because they're spouses, they both contributed assets equally 50-50. Now, the same rule does not apply if the co-owners are non-spouses. And the classic example of that we tend to see are, for instance, foreign non-resident alien parents that purchase property jointly with a US citizen child, right? So that comes up a lot. They're like, oh, well, we have mom and dad who are foreigners, are non-US citizens, non-resident aliens living outside of the US. And then they also have their daughter, right, who's a US citizen. And then the classic question is, well, can we just avoid completely because our daughter's a US citizen? The answer is no. All right. Actually, it's even worse than no. Because if the co-owners are not spouses, and in that same example I just gave, only the US citizen, the daughter is a US citizen, then what happens is it depends on the contribution of each individual party at the time of the purchase. So in that example, if the foreign parents contributed all the assets, but then put the U.S. citizen daughter on title, right? Then there's a FIRPTA withholding on 100% of the sales proceeds, even though there's a U.S. citizen daughter. It's not like a third that's not required. It's on 100%, right? And if they're able to prove contribution, who contributed what, then FIRPTA applies on the entire sales price. All right. All right. So there are some actual exceptions to the mandatory 15% withholding. I'm just going to say right out that these exceptions are very, very limited. And for all of you professionals out there that work in the New York City real estate market, these almost certainly never apply. It's so rare. I think in the last 5 years I might have seen one exception. That's it. But what are the exceptions? Well, the first one is an obvious one. It's what we call a non-foreign affidavit. That's a very typical closing document. That only applies if the seller is a U.S. person. They sign an affidavit saying, "Hey, here's my name, here's my social security number. I confirm that I am a U.S. person," right? If the buyer receives the affidavit, then they can reasonably rely on that affidavit, which means that the buyer doesn't have any sort of knowledge, actual knowledge that the person is a foreign citizen living abroad and so forth. Then that's usually sufficient for the buyer to rely upon without getting caught with penalties, right? However, having said that, by the way, buyers should not stick their heads in the sand. All right, they can't be like ah la 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 and just close their ears and say, "I don't want to hear anything about your citizenship, nothing at all. I just want to see your social security number." Then that's not going to do it, right? The buyer or buyer's counsel should be doing some minimum due diligence. There is a with exception for the primary residence low value property exception. I'll get to that in the next slide. And also the certificate of withholding exception. I'll also get into that in a little bit more detail. One point I want to make here, and it's another question that we typically get, is 1031 exchanges. Oh, well, my client's engaging in a 1031 exchange, so they're not subject to FIRPTA, right? No, that's not correct, unfortunately. FIRPTA still applies even if the foreign transferor plans on engaging in a 1031 exchange. So that's where things get tricky. And that's also why we like to plan things ahead of time. Like when I structure stuff for buyers, foreign buyers, we try to get a sense, an idea of their objectives here. And if their objective is to hold things long term for appreciation purposes, and they plan on potentially doing a 1031, we structure it not only to avoid estate tax or gift tax issues, but also to avoid the FIRPTA withholding on a future sale. All right. So we have seen issues in the past. I've seen them definitely where the FIRPTA does hinder the 1031 exchange process. And by the way, if anyone's curious, well, how do they get around that? Well, how a foreign transferor gets around the 1031 exchange is typically, unfortunately, if they haven't properly structured it, they just need to come to the closing table with an additional 15% so that can be sent to the IRS to satisfy the FIRPTA withholding, and leaving the 100% proceeds in the escrow for the 1031 exchange. All right. Now, this is why I wanted to go into this next slide, because common issues of FIRPTA exceptions, like I mentioned, they almost don't apply here in New York City. The one that I mentioned, the primary residence low value exception, it's limited to properties under $300,000. So good luck finding that in either New York City or Miami. I wrote that in, by the way, because I'm a Florida licensed attorney, so I also deal with closings and structurings in Florida. Buyer, not only does it have to be $300,000 or less that the foreign seller is selling, but the buyer must declare on an affidavit that they will use the property as a primary residence, I believe, for a certain amount of time within 2 years of closing. Most buyers don't want to do this, right? Most buyers just don't want to do this, usually on the advice of their counsel. Their counsel's like, "Don't sign this. You don't have to. There's no need for you to sign this. If you sign it and you don't end up using it as a primary residence for whatever reason, then you can be in trouble with the IRS." So a lot of buyers, so even if the property is $300,000 or under, usually doesn't apply anyway, because the buyer just doesn't want to declare that they'll use it as a primary residence. To be honest with you, if I was an attorney for a buyer representing a buyer, and they ask me that question, should I sign it? I will tell them no. As an attorney, I just don't think it's worth the risk. Um, Last but not least, there is something called the 8288B early refund exception. That's limited due to, so, let me just get into this. Because I do get this question. People do Google search and like, oh, there's this old certificate of withholding 8288B exception. And what is it? The certificate of withholding is basically asking the IRS for permission ahead of time, saying, hey, this is my actual tax liability. So $1 million, $150,000 FIRPTA withholding, but this application allows the foreign seller during the closing process to send a request to the IRS to lower it to the actual tax owed, right? And the seller has to send it with plenty of time. They have to show their tax calculations with proof of the calculations of the adjusted basis. And let's say, for instance, the seller is actually making a loss, right? They purchased it for $2 million, they're selling it for $1 million, right? Something catastrophic happened in the market or with the property, right? So it's very clear that they're making a loss. They would send that information to the IRS saying, hey, I made a loss, so can you please reduce the FIRPTA withholding to zero? Historically, after 90 to 120 days, the IRS would act upon it. They would send a certificate authorizing the FIRPTA withholding to be lowered in that situation to zero. Buyers of counsel would get that FIRPTA withholding, that withholding certificate, and then release the funds and allow the buyer to proceed without a FIRPTA the foreign seller to proceed without a FIRPTA withholding. The issue there now, pre-COVID, this system worked really well. I used to do a lot of these, actually, these kind of applications for my foreign sellers, foreign client sellers. And even if we didn't get a response from the IRS before the closing, which is pretty common, the IRS rules state that if you have an application pending that was sent in before closing that's pending, what they would allow the foreign seller to do is to at least request the buyer's attorney to withhold the amount, the FIRPTA withholding in escrow, in further escrow post-closing until we got a response from the IRS. And, usually we'd get a response after 30 days, 60 days after closing. I'd get the response, send it to the buyer's counsel, and then they would release the funds and we'd have, a post-closing escrow agreement or something along those lines. Unfortunately, COVID pretty much decimated the FIRPTA office in Ogden, Utah, and they were starting to slowly build it back up. And it went from like 90 to 120 days to over a year for a determination, which is just ridiculous. It's faster for the client to just wait the next year and file an income tax return than it was to get this quote unquote early refund certificate. So it's not really worthwhile. I tried it a few times over the last couple of years, and it's just it never works. I get responses from them way after closing, and also no one really wants to take the risk with these post-closing escrows because they can give substantial headaches with these delays. So that really is not an option. And now I think I saw in the news that 11% of employees of the IRS have been terminated by Doge this year, and they're looking to see a lot more. So it's to be honest, it's only going to get worse, if anything, and not better anytime soon. So let's just discuss really fast. So what are the penalties, right? What are the penalties and what's involved? What happens if a buyer of real estate fails to make the necessary withholding? Right. Well, number one, the buyer is considered the withholding agent for FIRPTA purposes. That is the default rule. You can actually apply if another person decides, oh, I consent to being the withholding agent and signs the documents as withholding agents, like for instance, an escrow company or something, then they can be liable, that other third party, but the default rule is the buyer, right? No one wants to be withholding agent because it's a liability if anything goes wrong. So the buyer as withholding agent is responsible for the proper withholding, right? So they have to collect that 15% withholding and remit it to the IRS with forms 8288, 8288A within 20 days post-closing. The penalty for failure to send those forms in within those 20 days of closing is very strict. It's $10,000 penalty. And the IRS sends these out. They absolutely love sending these out. These are spit out. If they see that there's a discrepancy within the dates of the transfer and the date that the forms and the withholding was sent, which was even one day after 20 days, there's going to be a $10,000 penalty letter. So this is super, super important for, for title agents and so forth to keep on top of this, for buyers and sellers councils as well to stay on top of this. Make sure this is sent within as soon as possible after closing. In addition to this $10,000 penalty, the foreign the buyer can also be liable for any unpaid income tax that is owed by the foreign seller. So if no withholding is made, not only are they going to get a $10,000 penalty, but if the foreign seller fails to file an income tax return the following year and pay the U.S. income tax owed, then the buyer will be liable to pay for that. Right. And again, it's a mechanism. It's like they want to ensure that buyers take this very seriously. Right. Because the buyer is going to be the one, because the IRS realized, well, the foreign seller took the money and ran. So we're just going to hold the buyer who has an asset here in the United States that we can put a lien on. Right. This is why buyers take it very seriously, or should take it very seriously. All right.
Chris, do you want
Just
to
real fast here,
last
because
10
I noticed
minutes
yeah, so
turn
I
to
noticed so
you want to just turn to the purchase side for 10 minutes? So we wrap up around 11.
yeah,
Just
yeah,
kind
yeah.
of different structures and basic advice, how to
Yeah,
avoid
yeah.
all this basically.
Yeah, yeah. So, just one last point. Last point I want to make on FIRPTA is there is a procedure to request a refund. They have to file. They have to file. The foreign seller has to file an income tax return, to declare it the year following. That is the way they request a refund. That's important to mention because some foreign sellers, they think they're just going to get an automatic refund. That's not the case. I mention this because if so much time goes by, then what ends up happening is that foreign seller is going to lose the opportunity to get a refund, and the IRS keeps the full FIRPTA withholding, right? I already mentioned that. There are some potential strategies, by the way, to avoid FIRPTA. I'm just going to tie this in basically with the gift and estate tax planning. So, in the very beginning, we had mentioned the potential for up to a 40% U.S. estate tax to be owed on if someone dies owning U.S. real estate. Now, this can be avoided, right? There's different ways in which we can avoid it, but like Andrew mentioned, I have to have a conversation with the client. I need to analyze their situation. I need to analyze the amount that they're purchasing. I need to analyze what the use of the property is going to be for. I need to see what their intentions are, what their objectives are. They going to move to the United States? Do they have U.S. citizen children, for instance, right? Are they going to rent it out? Is it short term? Is it long term? So we got to look at it. We've got to look at a complete evaluation of their picture to see what makes what is best for them, right? Some common some common structures that we utilize, for instance, is what I call a double corporate structure, like establishing a British Virgin Islands company where the client owns the shares, the foreign buyer owns the shares of the BVI company. That BVI company then owns 100% of like a New York corporation. Why do we do that? It's more advantageous for income tax purposes, but it also avoids FIRPTA on a future sale. But the client isn't subject to U.S. estate tax if they die, or even gift tax if they gift the shares of the BVI company, because the shares of a foreign corporation are outside of the estate and gift taxing jurisdiction of the United States. There's other ways we can accomplish it: a double partnership structure, irrevocable trusts, for instance. Sometimes a client will even tell us, what, I don't care. If I die, it's going to be my heirs' fault, right? So why do I care if, they're going to get plenty from me. They're already getting a very valuable apartment. It's fine. That's fine. Some clients just don't care. But as long as they've made an informed decision, right? That's the key issue here. You don't want clients coming to you after closing, discovering these issues of U.S. estate and gift taxes, and then basically saying like, hey, why didn't anyone tell me about this? Right now, I have this huge potential liability, and it's going to be super complicated to restructure. Right. Um, Oh, and last but not least, I just want to mention New York State has its own withholding. I'm not going to get into this. It's basically applies to any non-resident. It's not just foreign sellers. It's any non-New York State resident. The New York State rules are much less harsh. It's only withheld on the net capital gain. It's filed on IT 2663 and 2664, and the actual seller, non-resident seller, is responsible for this, unlike FIRPTA. But that's something as well to keep in mind, to let your clients know as well that there's withholding not only for FIRPTA, not only for on the federal level, but also on the New York State level. At the very end here, I just put a little cheat sheet here where we can send out this presentation. Just take a look at that if you have any question. I was trying to keep this as simple as possible, but it started getting a little too elaborate. But it's just basically when FIRPTA withholding is required, when it's not required, right? So if you're ever thinking about it and you have a question about it, take a look at this and see whether this answers your question. If not, feel free to reach out to us. We'll be happy to help. Last but not least, the obligatory disclaimer. I'm not your attorney. I'd love to be your attorney, but I'm not your attorney. This is just for informational purposes only. You should always get necessary advice from competent counsel or competent parties, right? So, with that said, Andrew, do you want to add anything?
Um, yeah, just some practical considerations. I mean, I think it's funny, the international business is not as crazy as we had expected, or, due to obvious issues with, tariffs and kind of, I think there's a little bit of trepidation, even despite the markets. But we are seeing, our fair share of international clients. Um, on a quick note, one of Chris's superpowers is forming entities and structures for domestic clients that want anonymity. We've been fortunate enough to work with some high-end deals over the years. And while we can't guarantee anonymity because our city is very intrusive, if it's done properly, it should be accomplished, right? We did a big deal at 220 Central Park South, and to I guess pat Chris on the back. The article, the title of the article read anonymous buyer purchases, XYZ. But we do that often. It doesn't even have to be a huge buyer, it's somebody that just wants some anonymity. But just some practical considerations for international clients. We find they often like to purchase near landmarks, that maybe a domestic buyer wouldn't want, such as like the Empire State Building. Brooklyn's become an international destination. We want to, as real estate professionals, we're always incredibly proactive, right? But you want to be even more proactive. You want to get further ahead. I know sometimes you wait to introduce me until the offer's accepted or about to be accepted or they're about to put an offer in. I would do it, even earlier when you just start to look around. Closing cost estimates, title insurance. The fees in New York compared to other countries are dramatically different, right? It's setting up structures, getting them comfortable if they're financing. So just whatever you do in with a regular, local client, I just do it earlier, right? Because inevitably there's gonna be back and forth, where I'm on WhatsApp all the time. I have a client right now in um, overseas in China, and her mother's sick, and it's hard to get in touch because of the 12-hour difference. She's been missing all the phone calls. So things tend to just drag, right? We can sign a contract virtually, or I'm sorry, not virtually, we can sign a contract via PDF, but a closing, do we need original signatures? Do we need a resolution? Do we need a power of attorney? Do you have to go to the embassy's office? So just get ahead with that. Be super proactive.
Yeah. And I just want to make sure, because John, I just want to make sure I answered these questions right. John's question was, will FIRPTA apply to a foreign investor who already owns property in New York State but transfers to a single member LLC? John, the answer is it will still apply because an LLC, the default rule for an LLC of one single member is transparent. It's just what we call disregarded entity, so it's taxed to the foreign person. So FIRPTA still applies. However, a neat little trick that sometimes that can work, depending on the circumstances, is we can add an additional member, right? Like a spouse, for instance, even with like 1% or 2%. And even if that spouse is also foreign, we then have now turned the LLC into a domestic partnership, taxable as a domestic partnership. And so that exempts it from FIRPTA, right? Legally exempts it. Um, Another way an LLC can be is if the foreign the foreign owner elects for the LLC to be treated as a domestic corporation on 8832. But that's got to be done very, very carefully because that election can really cause a real tax headache if done incorrectly. And Mary also has a question. Can an international buyer change the purchase structure post-closing? Yes, Mary, they can. They can. They can. It's just the options are a little more limited. For instance, a I can't transfer it to like a foreign corporation without it recognized being a phantom sale to the foreign corporation. I can't gift it to a irrevocable trust, for instance, because then there's going to be gift tax owed. But there are solutions to it. There are definitely solutions. And I'd be happy to have a conversation with any of your clients if that's the case. Um, all right, I think that's about it, unless hang on, Mark. Mark says, sorry, can you repeat that? How can you add someone to the LLC. Yeah, it's actually relatively straightforward, Mark. You just because the LLC is already on the deed, it's already on title. You don't have to change the deed or anything. You just have to change the members. That obviously depends on where the LLC is established and organized, but usually that's just through like a membership transfer form, right? Or issuance of additional membership interest in the LLC. It could be as simple as that. All right. We'll just give it one more minute for any more questions, um, but I think that's about it. But yeah, if you guys can have um, oh, Andrew, I think this is more of a question for you. The foreign buyers like to buy near or in landmarks. Yeah.
Yeah, we find they like to buy, they like to brag to their friends, so their friends in another country know the Empire State Building, they know the Brooklyn Bridge, they know, the World Trade Center, the Oculus, so they know Park Ave, they know Central Park, right? So we find, not always, but there seems to be a trend of purchasing near, major New York City landmarks.
Yeah. So I think that's it. But as Andrew had mentioned before, and just to reiterate on a closing note, just make sure that this is discussed. Any FIRPTA withholding is discussed way ahead of time. We have had issues in the past where they only find out halfway through closing or when they encounter the closing statement, and it could be very unpleasant at that point. So look, if you want us to have the conversation with the client, we'll be happy to have that,
Yeah, but
we'd be
just
happy to do.
introducing the concepts again, like, listen, clients come to me with accounting questions. I'll float the conversation for a minute or two, then I'll loop in the accountant. Just simply stating, hey, and you can say, hey, I went to a seminar, right? That means you're proactive. And it's my understanding as an international client, you may want to buy in an entity to perhaps avoid estate tax and FIRPTA, which is first of all, it's a withholding, right? It's not a tax. I think I don't know if we glossed over that, but
Yeah. It's a
it's
withholding
it's a
mechanism. Yeah.
withholding. So the IRS protects themselves. They take that money as basically security to make sure they get paid. Think about this situation, the classic situation. Chris is from Brazil. So an owner of a property lives in Brazil, has no connection to America except for one property in New York, very little assets. So let's say they sell that property. If the IRS doesn't hold back the 15%, that person may never return to the United States and the IRS is out that money. So they hold back that money. And by the way, the New York State Department of Finance does the same thing. If you haven't lived in your property a total of 2 out of the last 5 years, There's also withholding for New York State capital gains. So it's just a security mechanism.
Okay.
But have a great day. We'll follow up with a few good emails and we'll go from there.
All right. Thank you, everyone. Take care. Thank you for participating.
Thanks. Bye bye.
Bye.